Just when we thought the days of UK political upheaval and chaos were behind us, we were given a stark reminder on Thursday that this is just in fact the new norm. During the cabinet reshuffle, we did see some changes taking place, some of which were unexpected, some of which went as we were anticipating. But the one surprise came from the Chancellor of the Exchequer, Sajid Javid, resigning. Now, this was a huge surprise and got an immediate reaction from the markets, especially given that the reasons he gave for the resignation were that he just simply couldn't work under the conditions that were being laid down. He said no self-respecting person could work under these conditions. Now, the standout condition that he did allude to was the fact that he was told all his advisors would effectively have to be sacked and replaced. Now, this is not something that will have to face a new Chancellor, so they're not necessarily working under the same conditions, but it does give some insight into how Boris Johnson wants his team to work. It does seem as though he wants them surrounded by the right people and what he perceives and Dominic Cummings perceives to be the right people. But then people are also looking for other meanings and the other reasons as to why Sajid Javid will have resigned his post. And the market reaction again would suggest this does signal that we are going to see a far more expansionary budget when we do in fact see it. It was already quite clear from the promises that we'd seen from Boris Johnson during the election campaign that we were going to see a more expansionary budget, that the Conservative Party was going to try and push the boundaries of its own fiscal rules. But this would suggest that they may be going to overstep them and potentially even to some degree which may have contributed to Sajid Javid actually resigning his post. Again, this will become more clear over the coming weeks and months, but the markets are clearly pricing this in. We initially saw a rise in UK bond yields, for example. That is indicative of the market perceiving higher borrowing costs on the back of higher borrowing. We saw the FTSE 100 underperform the rest of European markets because the rally we saw in the pound. Of course, everyone at this point has spoken and knows about the inverse relationship between the pound and the FTSE 100. Around more than 3/4 of revenue generated within the FTSE 100 comes from outside of the UK. So when we do see the pound rise, we typically see the FTSE underperform, and vice versa, because of course when it comes to reporting, when those profits are converted back to the currency, a weaker currency actually is positive for the revenue and earnings numbers. So what we've actually seen over the last 24 hours does suggest that the markets are now anticipating a more expansionary budget than previously anticipated. And of course, we've seen that Boris Johnson has taken on some big decisions already with regards to HS2 and Huawei. So breaking the Conservative fiscal rules would almost be in keeping with the type of Prime Minister he has shown that he wants to be. Now, as I've already alluded to, the pound did rally on the back of this, and as we can see from the chart here, it actually did break back through 130 where it had been hanging below for much of the last week. These gains are maybe a bit smaller than some of the movements that we've seen around the Brexit period and even over the course of the last few weeks. But these were very clearly related to the reports that were pouring out late yesterday morning and early afternoon with regards to that resignation. We've broken back above that 130 level, which has at times been quite an interesting area of support and resistance, as you can actually see on the chart right in front of you. Throughout 2020 up until around this time last week, it was quite a major area of support. We kept seeing the buying pressure come back in around those levels. So that was a very bearish move that we were seeing when we finally broke below those levels. But these latest reports are indicative of more spending, which means more economic growth. And in that, in turn, you would imagine could reduce the chances of the Bank of England cutting interest rates at one of the upcoming meetings, something they had previously signalled they were considering doing. And that is, of course, a Bank of England that is under will soon be under a new governor when Mark Carney leaves in March, just before the next meeting. So as I say, things are looking a little bit more bullish now, but we do have to see if it can hold above these 130 levels. And if it does into the end of the week, then we could potentially be eyeing 132 as the next major level of resistance.